Okay, please confirm that
now
you
we can see you.
Okay,
now we can see you.
Thank you so much, Ronald, and thank you for giving me this opportunity. Good morning, everyone. My name is Fred Kato. I'm happy to be on this platform to share with you what I have to share with you. And thank you so much, Enterprise Uganda, for having such a platform so that we can be able to talk to people. I'm happy to be here, and my responsibility is to share with you what I was told by Enterprise Uganda to share with you about loans, when and how do they go bad, what can we do? And maybe before we dive into our conversation today, as I said, my name is Fred Kato. I work with Equity Bank. I lead the SME team here at Equity Bank. Of course, I have a lot of experience in credit. Since my university, I think that is 18 years back, I've been doing credit. Up to now, I'm in credit. So I've worked in over 3 institutions in credit, and up to now, I'm still in credit. So I'll be happy to share with you today. So I think without wasting time, Ronald, allow me to go into our conversation. I think you can allow me to put my screen up so that Wednesday, yesterday was a great day for you, and we really treasure you. You are our mothers, you are friends, sisters, and women. You are our wives. We really treasure you. It was such a great day where we celebrated you. So let me just give me a second to put my screen up so that we can dive into our conversation. Ronald, you'll confirm whether you can see my screen?
Yes, I can.
Okay, thank you so much. I came in a little bit, I think 7 minutes to 8 a.m. I don't know whether you had a word of prayer. It's important to pray whenever you're going to start anything. Ronald, did you pray? Oh,
please do go ahead and pray. We would be glad.
Okay. Okay, let me take the responsibility to pray. Okay, Lord God, we thank you for this moment. We thank you for having people here. We thank you that you have given us a gift of life. We thank you for the people on this call, Father. As we dive into conversation, Father, guide us and let us learn from this call and be able to implement whatever we are going to learn in this call. Let us interact. Let us be able to network on this call. Father, we pray in the mighty name of Jesus. Amen. Okay, today's topic is when and how do loans go bad? Of course, many people borrow, and not only people, but companies. People borrow right from your friends, right from at school. We used to borrow, but now we wanted to know how the loans go bad. So, so many right from regions. I know some of our brothers and sisters in the Muslim world, they don't require to borrow with loans that have interest, that is riba. But I know, like now, which we have facilities of that don't attract riba, that is interest. But also, when it comes to Christians, I think some of them borrow, others don't borrow. But the most important thing is that sometimes you can't survive without borrowing. Many companies borrow, people borrow. I've seen a number of people are surviving in this economy. They borrow, and they have been able to make a lot of things from borrowing. So it is important to understand when to borrow, how to borrow, and also see how you can manage your credit. And I think before the end of today's conversation, we would have gone through a number of things. But before we understand how the loans go bad, and when do loans go bad, we need to understand, why do people borrow? Is there a need for people to borrow? Do we need to borrow? But maybe we can have that discussion to really understand and when do loans really go bad. So before we dive into how loans go bad, many people borrow. Different people borrow, companies, individuals, and people of different categories borrow, and borrow from different institutions, borrow from different individuals. But people borrow, companies borrow because of different needs. And most importantly, people borrow for working capital needs. People want additional working capital. They are doing a business, but they need more money so that they can boost. They have a demand. Demand is there. Customers are there, but they don't have enough money. They have the science to business. They have experience, and the demand is there, but they need working capital to boost business, to be able to do more. And that's why people go and borrow from banks and all other financial institutions. Others need to acquire assets, right, from generating businesses, generating incomes. Others need personal assets. You need to buy a car, you need to buy land, you need to buy a house, right, from income generating assets, but also personal assets. People borrow to acquire such things because they don't have money at the beginning, at the moment, but they need to borrow to get maybe to acquire such assets and then pay later. Others need development. I've seen people developing, putting up structures, developing a number of projects because they borrow and then they pay in manageable installments. So that's why some of the people borrow. There are a number of reasons, but I captured a few here that are going to drive us to our main point, why the loans go bad and how can we manage that situation when loans go bad. But also, many people have contracts from different institutions, from governments, from NGOs, and many companies. They have got the contract, they have the expertise to do the contract, but they don't have money. And the contractor, or the employer is saying, here is the contract. Sorry about that. Sometimes people borrow because they want to execute such contracts, and then they pay them, because most employers don't pay you money, don't give you money, contract, and then they will give you money depending on how you have executed the contract. In fact, most of the contractors, the employers, they'll even have to validate whether that's what they told you to execute or to do, and then they pay you. And because of such reasons, people come to different institutions, banks, they borrow so they can be able to execute such contracts. And sometimes people want to invest short-term and long-term, and not that. And you need to understand whether you are doing an investment which is short-term or a long-term investment. And that one is key to understand, depending on your business or what you are going to do. Others want to invest. And like I said, personal needs. You may want to buy a car, you want to buy maybe a TV, you want to buy things in your house, anything. You may want to buy a cooker. People go ahead and borrow because they earn money, maybe on a monthly basis, daily basis, but they can't be able to acquire such assets at once. Yet they can earn and get income maybe on a monthly, weekly, daily basis. So it is important to understand why people borrow, and it is important to know when to borrow. So those are some of the reasons why people borrow. But in most cases, people don't manage their debt. They don't understand when to borrow, how can I borrow, and where to borrow from. And it comes to the end whereby people are suffering with debts. They go through a lot of stress. And at the end of the day, they lose their businesses and even their assets, because maybe they didn't understand some of the key things that you need to look at before you go for a loan. But what about when everything was okay and now the loan has gone bad? How do you handle that? So that's what I want to focus on, because I know after COVID and what has been going on in the economy, what it brought in, COVID. So many businesses are down, many businesses are not making money, and some people borrowed money, and banks and other institutions are demanding. But how do you manage such a situation when you borrowed, you didn't intend it, but now you are stuck? How do you handle that situation? And that's what I want us to focus so much on. See, how do we handle it? Do we handle it before, after, or we can see it even at the beginning? But before we go into that, it is important to understand what causes default. Because you can borrow and your project is viable, but at the end of the day, you default, you don't have money to pay. But it's important to know the causes, and then you get reasons of how you can prevent to default from any loan that you have really acquired. But I categorize this in two ways. That is external, an example of COVID that came in, and any other natural calamities. You can borrow money, but something happens, fire, anything, drought, you can borrow money to maybe for agriculture, to grow something. Drought comes in and you can't. You borrowed money and had over 10 acres of maize. Because of drought, you can't harvest. There are such issues. What do you do when such things come? But also the nature of the lender. Many people are borrowing left, right, and center, and then don't really care about who gives them money. But it's important to understand who is lending you money. Is he a regulated financial institution? What happens? What are the advantages of borrowing from regulated financial institutions? Do you want to go to a money lender because it's fast to give you money the following day? Do you need to plan your borrowings before? Where are you supposed to borrow from? So it's not a matter of getting the money, but it's also important to know company regulated. What about when I default? And same applies to saving money. If you are saving money, you need to know where you are saving your money. You can wake up tomorrow when the bank or the institution has closed. So that's why it is important to know how to borrow from a regulated financial institution, where you can, where someone has a regulator that cannot do anything that is not under the law. But you get people borrowing from all kinds of lenders, and they face challenges and they can't even handle it, because for them, they will have to take up the properties. Some lenders lend based on security lending. But where you find that most of financial institutions, like now Equity, they base on cash flows. It is important that a lender bases on cash flow than just basing security. When they look at only security, that means they're after your security, they're after your collateral. That means when you default, anything can happen. So it is important to identify who is giving you money. Is he after your security? Is he after your cash flow? And that's why sometimes we advise people here at Equity, tell them, you know what, you have a building, you have a very good collateral, but we are sorry we can't fund you because your cash flows cannot pay this loan. Not because we don't want to lend, we have money that we want to lend, but we don't want to give you money and then you default, you face challenges and you say, oh, equity. And that's why we do some bit of financial literacy before we dish out money at Equity here. But also, besides the external, there are a number of internal, internal factors that really affect or cause default. And one of them is about inaccurate or inadequate appraisal. And this contributes to over 70% of the default. Sometimes it is the borrower, sometimes it is the lender. The borrower may not disclose a lot of information to the lender, and information is not captured. So somehow the loan is structured wrongly, and maybe they give you less money, and maybe you're not able to do what you're supposed to do. Sometimes about the lender himself doesn't have capacity to extract or to get enough information from the borrower. So in that way, they do a wrong appraisal, they recommend wrong amounts, and even wrong structuring. Of course, if the structuring is wrong, the default will come in. And as we are going to see how does that come? Sometimes people default not because they're not making money, but because of loan structure. The loan was not structured well, and because of appraisal. Maybe the borrower didn't disclose. I've met a number of borrowers who don't want to disclose their information and source of incomes, and they think that they don't want to disclose a lot to the bank. And when you do that, the bank will also maybe give you less money or will not give you as per your request. So it is important as a borrower to disclose everything, because regulated financial institutions can't just disclose information. We work under regulated financial institution. Confidentiality, that's key. One of the things that we move on regulated financial institution. We don't just disclose customers' information. I think you saw the time when URA wanted information from banks. We said, no, we can't just disclose information. So we are regulated, we can't disclose customer information. And sometimes when you disclose such information, it makes the lender to make an appropriate decision. And like I said, 70% of our customers or loans go bad because of poor appraisal and sometimes lack of information. But number two here under internal, also over and underfunding. Sometimes you request for a loan and you request a lot of money, which you don't need. This is a loan that you are going to pay back with interest. So it's important to get the right amount of money as per your need, not because you think you do it. Sometimes it's about underfunding. Many customers request money from banks or financial institutions, and they are given less money. The person has a need, maybe to execute a contract, maybe to buy a vehicle, but the financial institution gives less money and the vehicle is not bought. The purpose is not met. Of course, default is going to come in, and all this comes from appraisal, where maybe the borrower doesn't disclose information or the lender has not understood the business of the customer. And such things bring a default, of course. But there's this number three, which I call
Fred, we seem to have lost you a bit there. Sorry, colleagues, let me just try to see if I can get Fred. I think his network connection. All right. Sorry, colleagues, let me just try to get back Fred. I think his network connection dropped, but let's try to get him back into the call. I think we lost him briefly. Yeah, as we wait for Fred to come, if you have any questions, please don't hesitate to put them in the chat box. Just put them in the chat box so that we can be able to have them answered. Let's just try to get Fred back onto the call. I think his line dropped. Let's see. Okay. All right. Great. I think Fred is back. Sorry, Fred, we had lost you a bit there, but you can just reshare and then we proceed.
Okay, sorry about that. Let me reshare.
Great.
Please confirm that you can see my screen.
Yeah.
Okay.
Yes,
sorry about
yes.
that. Sorry about that. I was talking about liquidity mismatch. You have short-term needs, but you go for long-term funding, or you have a long-term need, you go for short-term financing. That has caused a lot of default. I can give an example. I was giving an example of a school where a school may need maybe to need to construct a building, maybe a classroom block. They need money to construct a classroom block, but they go for a short-term funding. An example, they go for a loan of 1 year, of 2 years. What will happen is that the installment will be so big. And remember, if the installment is big, working capital is less. They will not pay their teachers, they will not buy food. It's not that the business is not profitable, the school is profitable, but just because there was mismatch, they got money and they put up a building. They are paying a lot of money in terms of installment, and whatever they collect from school fees, it goes to paying the loans, and teachers are not paid. They'll stop teaching. You find a business, a good business, going down. So this is a major problem that many business people have not really put into consideration, that they don't really consider this when they are requesting for a loan. An example I'll give, because of course I work in equity, I'll give an example of equity. There are different facilities for different purposes. If you need short term to pay teachers, to buy food before the term begins, to maybe to do some general renovation of the school, you don't have to go for a long-term loan, go for a short term. Like at Equity, we offer over I think up to 200 million unsecured. That is for schools to help them to cater for short-term needs. You want to open a school, you want to buy food, you want to pay teachers, come for a quick loan as long as the school fees are going through the bank. Then you sort out those short-term needs. Students come, report, within 1 month, you pay that loan. So there you've gotten short-term funding for short-term needs. But you can't get this money, I'm talking about the 200 million, this unsecured money we have here, and then you go and set up a building, or you buy a lab equipment. That because they will demand it after a month or 2 months, you don't have it, then you'll be able, you'll default. So it is important to understand, to structure your financial needs and then go for those loans that cater for such needs that you have. Short-term funding for short-term needs. And long-term, you get a development loan, you go and construct a building. You'll pay a smaller installment for maybe 10 years. I think it will give up to 10 years. Because you're setting up a building, get a loan for 10 years, pay small installment. You want short-term capital, get short-term capital, then finance. There you can manage, and then sometimes it's about the staff or the employees, or let me call them relationship managers. Sometimes they don't guide customers, they don't get enough information, and sometimes customers don't disclose. Sometimes they lie, that I'm going to do this, then they do something else. And that takes me to the next point, which is misuse and diversion. Someone has got money, we've given you money for short-term purposes, but you divert it for long-term or for non-income generating projects. There you are going to face challenges to default, and you will default. So it is important that, because you can have like 5 loans running. You can have a development loan running for 5 years or 10 years. You can have a short-term working capital to cater for your short-term needs. You can have a small loan maybe for invoice discounting. You're a supplier, they give you an invoice, they have not paid you, you need the money to go and buy goods. You come and we discount your invoice 70%. We give you money, and then you proceed with your business. So as you go to the bank, understand the products there, and also explain really what you need to do. You don't need to divert short-term money for long-term projects. You get challenges to be able to pay, and that will cause default. And also the other one is a misunderstanding with customers and lenders. Sometimes the relationship manager get issues with the customer, or the customer gets issues with the relationship manager or with the bank. Of course, when there is misunderstanding, there is no relationship. I want to encourage you, businessmen on this call, to really have a good relationship with your relationship manager, because this is a person who speaks for you, who presents your facility, your loan file to the committee to approve for. So make sure that you give them enough information And the same applies to maybe relationship managers. If you don't keep a good relationship, I saw it during COVID. Customers who are our friends, they could prioritize. They say, I have loans in 4 banks, but you know, Fred, you are my good friend. Let me first pay your loan. Maybe the other guys will wait. So it's a relationship. Make sure the relationship is there for both the lender and also the borrower, so that you can be able to walk to your RM, explain your need, and they'll be able to structure for you a facility. And that is key. Sometimes customers are not taken through poor orientation of clients on learning processes, and they don't know how long it's going to take. They don't know how the processes are going to be. It is important, the relationship manager, to explain to a customer that you are applying today, but you will get a loan after a month. Maybe this is what you have to go through, that when the loan is approved, we need to perfect your security. We need maybe to put a mortgage on your collateral, provided a land title. That's when you get money. Then the customer will plan that if I'm to take a month to get money, then let me plan. And that takes me to the other point of delaying loan processing. Sometimes banks delay, or other institutions, they delay. And that's why customers or people go to money lenders, because they know when they go there, money will be there. But also it is important to plan for your borrowings. You don't have to wake up today and say, now I need money. You can structure a facility, even apply, even when the need is not there. You know, I'll need money, and when the term begins, I'll need money at this point. So let me apply for a loan. It is approved, they get an offer letter. Maybe they mark an OD, overdraft, that when you have a need, you draw money from that account. You don't have to consult anyone. You don't have to rush, because anyone running a business at one moment, you need money. So you need maybe to have an overdraft already approved. It's there. Cater for maybe your needs, short-term needs, need money quickly, other than going to a money lender who is going to charge you a lot of interest and who is after your security. That's why for them, they ask, what are you giving me as security? That's what they are looking at. And when you come to the banks like Equity, they ask about the cash flow. The lending is about cash flow based. They look at how your cash flows are coming in, and it's based on that. Of course, there are a lot of fraudulent activities. That's my last point here on the causes of default. Sometimes it is an intention of the customer. The customer comes when the intention is to defraud the bank, or it's about the bank staff that is after defrauding the customer. The money is given, they charge them a lot of money, they ask things like that. So all those can cause a default. You make sure you don't spend a lot of money as you are processing a lot your facility. You may go to a certain institution and maybe an RM, that is the relationship manager, will tell you maybe, before I give you money, give me this amount. No, you can't do that. Regulated financial institutions don't do that. Equity, we don't do that. That's why we value our values. We respect our values. And if such happens, that RM cannot work in the bank. And sometimes customers are squeezed in the corner. They can't talk. There are different levels that you can go. It's not about that RM. The bank can be able to change an RM for you so that you can be able to service. So many times loans go bad because of some of the reasons that I've shared with you. Some of them are external, others are internal. But there's a way we can prevent them and then plan and be able to overcome such dates. And like I said, one of the causes the external is about the natural calamities. Anything can happen. Something can happen without your notice. COVID came in. Fire can come anytime. At Equity, we insure all our loans. Sometimes people don't want to pay insurance. They think insurance is eating money. But just imagine a person who has planted over 10 acres of maize and drought comes in. There is agriculture insurance. Think about fire that can gut your business. What will happen? So you better pay this small money for insurance to cover for you in such incidents. But also, many people don't know that there are provisions of loan restructure. As regulated financial institutions, we are able to restructure your loans depending on your cash flow. Maybe you've been earning money, you've been having a business, cash flows, you have a problem, something has happened, and cash flows are not the same the way when you borrowed. So you come to the bank, you can tell the bank to request for a restructure. They can be able to restructure and give you, it can be a moratorium, they can give you like talking about a grace period, maybe 1 or 2 months, then you reset, maybe they reduce your installment, you've been paying 3 million, then maybe they extend the period, you pay 1 million. All those are provisions that the bank offer. And that's why I talked about the nature of the lender. When you go to some institutions, they'll tell you, no, we need our money. Come what may, we need our money. But if you go to regulated institutions like Equity, you'll be able to negotiate, and then they'll be able to extend the period and reduce your installment. And that's why I said the borrower matters. I mean, the lender matters also. Of course, you may look at quick money, but sometimes in the long run, you will get issues. So borrow from regulated financial institutions. There are different kind of loans. Some of the people complained about turnaround time because the lender is going to give me money in 1 week. Yes, it may come in 1 week, but you are going to face challenges. They will take you collateral. You'll pay a lot of interest. What about when you plan before and say, now, I'll need money, let me plan. Let me just mark a note there. Whenever I get challenges, I'll draw money. Yeah? Let me plan before. I'll need money when the term is going to open. So it is important to plan your borrowings. And those are some of the mitigants or solutions that we can be able to adopt. So don't fear, come to the bank, negotiate. That's why I told you, make sure you have a good relationship with your relationship manager. That's why we call them relationship manager. They are to manage relationship, good or bad. You need to work with them. Where the relationship manager does not maybe support you, there are different levels in the branch. Branch manager is there, the supervisor is there. If the branch can't, then go to the head office of that institution. You need to put forward your case. It's not a crime that you borrowed. It's not a crime that you got a challenge. You need to come and discuss, and then they will get for your solution. And for the issue of inaccurate or inadequate appraisal, of course, it's in most cases about the institutions that are lending. Most of the staff or the relationship manager in some institutions are not trained. At Equity, we have an academy where we train our staff. We equip them with skills to get information from customers. Even when they don't want to disclose some information, they end up disclosing. Those are skills that you can't learn in 1 day. It's continuous training of the staff. And appraisal, the biggest problem is about the lenders. It's like 30% for the borrowers where they don't want to disclose information. They think when they disclose, maybe banks or financial institutions, they'll disclose their information to other people. It's not like that. That's why it's important to borrow from graduated financial institutions that have a responsibility of confidentiality. The over and other financing, I've got so many customers in my banking experience where a customer needed the money, but the RM recommended less money, and the customer cannot do what they were supposed to do. Of course, the project is not done. So, or sometimes it was over finance because someone was given a lot of money, then they divert it, and then they default. So ask for the money that you need so that you don't divert it. And also, if you are not given the money that you needed, you better leave it than taking it and then divert it. So it's about you to prepare your investment plan and plan properly. If the money is not enough, you can appeal to see whether sometimes the lenders don't understand your business. Make sure they understand the business. And then what I talked about, the liquidity mismatch, and this has affected so much. I have one of my friends, it's operating a hospital, and one of the biggest challenges that I think he mismatched the funding. And, he had to invest. They gave him short-term money. He invested into long-term. He put up a building, a hospital, And now, remember, most now hospitals are allowing insurance. Most of the customers are not for cash, they're on insurance. Insurance takes a lot of time to pay the invoices, like 2-3 months. Yet he has to move on, he has to pay staff, he has to buy medicine. Now, the problem of this customer was about to mismatch and the structuring of the loan. This customer, the one I'm telling you, or anyone, this call, would have got a short-term funding, maybe for invoice discounting for those invoices, would have got a development loan to construct a building. That will give him maybe a manageable installment. Then whenever he gets invoices, he comes to the bank, they discount them, they give him money to operate the business. All that would have been very good. And remember now, like an hospital now well constructed, how can it fail? There are businesses that I'm confident of, unless there is mismanagement, they will survive. We've seen schools where I've studied from, they are still there. So why can't you finance such business? We've seen hospitals, they're still there. Such projects are long term. So it's about how you structure your finance. Diversion of funds, please, when they give you money, make sure you invest it in profitable projects. Don't divert. Diversion is a cause of default and may lead you to lose of your projects, your properties and your business. And I think I've discussed this about the relationship management. Ensure that you are in line with your relationship manager, your credit officer, with your bank. Someone told me there are 3 things that you should not have. You should have a doctor, your personal doctor, a banker at any time. Those are friends that you can't let go. And maybe a religious person, can be a pastor or sheikh or anyone who can pray for you in case of anything. So such people, so that when you wake up, you have a challenge, you can do that. Now, if you keep a good relationship with your relationship manager, with your bank, anything you need, they will always advise you whenever you get a challenge. You call them, you sit down and analyze that. So, and that's the next point is about the orientation, and that's why I'm on this call. And I think we do that before we give out money. We make sure that customers understand what they are supposed to do. Sometimes we regret your application. Sometimes we tell you, you've requested for less money. Maybe increase. Maybe this is too much. Maybe I can reduce it. Now, there is this big issue that has caused default, delayed loan processing. Sometimes we don't plan our borrowing, and I've talked about this. Let's plan, but also don't just sit when you have applied for a loan. Ensure that you engage your RM, but also on the side of the RMs, as a bank, this is something that we track, turnaround time. And if the staff has delayed, we always track that. Actually, this is part of the KPI of most of the staff or relationship managers. So you need to follow up from your RM, supervisors, head office. Don't sit, because once you lose the project, everything is gone. Of course, avoid fraud. And remember, right from the lender and also the customer. We've seen customers, intentionally, they have come to defraud the bank. But of course, it's about, some of them are, it's about our staff who misbehave, and not specifically maybe for financial institutions. Many financial institutions who don't really speak with their staff, train them, they misbehave, and that causes default. But as I conclude this session, is that you need to plan your borrowing. Brief. You need to plan your borrowing. Don't borrow for just borrowing. Understand what you have. You can't have 100 million as your working capital and you want 200. How do you manage that? Of course, Equity will check that. But also, most importantly, there are provisions of restructure. Don't die alone. If the banks, regulated financial institutions don't just come and take your property. Keep in touch with them, communicate. Communication is key. And you see, that relationship manager is the one who represents the bank, is the one who tells them, no, the customer has a challenge. So keep in touch, provide information. It's not about financial institution taking the collateral. It's about you pay, and that is about the nature of the lender. So I wanted to stop here for now, and I wanted to thank you for listening in. I welcome questions and answers. Thank you so much, Ronald, for giving me this opportunity. And, over to you.
Thank you so much, Fred, for those insights. They are very deep insights, and you have made it simple enough for us to be able to appreciate and understand. There are a number of issues which came up. I think one of the things which was clear is that a loan seems to go bad way before it actually goes bad. If we don't do the things we are supposed to do at the right time, if we don't get the right kind of money we need, sometimes we need long-term money, sometimes we need short-term money. The moment we don't do that, it is a recipe for disaster. So at this moment, we will have an opportunity to ask some questions. Colleagues, feel free to put up your hand and ask a question, or you can drop your question in the chat box, and then we'll allow Fred an opportunity to be able to answer. I see a question here from Monica. Monica, how are you? Monica asks, why don't borrowers with good credit history get lower interest rates? The unilateral rates discourage good borrowers. Yes, Fred, you can help us comment on that question. I see Mwami Mwonge has his hand up. Please go ahead. Let me just ask you to unmute.
Yes, good morning, everyone, and thank you for the session. Now, I don't know whether this can be answered here. There is something I thought about recently that needs to be worked on as far as Uganda is concerned. When you look at all the offer letters and all the agreements and understandings we have with the banks, it appears like all the burden is on the customer. You don't see as clauses like what happens in the event that a customer defaults, not because of his or her error, but because of issues like wars, like catastrophes or pandemics. I think the offer letters are all a bit imbalanced. You look at every burden is pushed on the customer. I'll put up an example like we've just gone through of COVID. Schools were not operating for 2 years. And when we came back, banks are not even able to listen to waive off interest for a year. So I don't know how this can be handled in the future. I think it is something that needs to be thought about. There are times and events of default, not because somebody swindled the money or misused, but because of other factors like those pandemics I've mentioned. So we need to see how best we can handle this in the near future. Otherwise, we shall see many businesses crumbling and getting low because of loan defaults, not because out of their error or want. Thank you.
Thank you so much, Mr. Mwonge. If there is anyone else, please do put up your hand. I see another question here from Roslyn Akol. He says, what type of loan products are available from banks for both short and long-term needs? Yes. And then Aaron asks, you talked about different loans for different needs. Can all these loans be given using the same collateral? Or do actually all these loans need collateral? Possibly you will touch on those, Fred, and then we may have another round.
Thank you so much, Ronald. Can I use the same collateral for different loans? Yes, it can be done. And it's about structuring. It can be structuring. In such a way that as you have a long-term loan, but also you have a short-term loan. Hope you can hear me. Can you hear me?
Yes, we can. Yes, you can. We lost you for a few seconds there, but we can hear you.
Okay. there are different products of short-term and long-term. Like I showed you on my first slide here. Each purpose here has a different product that banks can be able to offer. If I can speak about equity, there are different products that can be aligned to different purposes. So it's about you coming to the bank and tell them what you really want to do. It doesn't mean that if you've got a development loan that is now for a long time, maybe you want to construct a building, you can't get a working capital loan. So there are different facilities that can be offered, and using the same collateral. It's about you to inquire from your financial institution. They can be able to explain. And also, there's a question of, actually it was a concern about the burdens that are put on customers, where everything is put on customers, but also he did mention about the catastrophes that can come in place. What can we do? Of course, I'll speak on the side of equity, not for other institutions, but at equity, actually, we face such challenges. Of course, especially schools were closed, bars for quite a long period of time. But if you can remember what I talked about, the relationship you keep with your bank, I've seen cases where we waive off interest. Well, I've not seen cases where a bank waives off principal, but I've seen cases where interest is forgiven and the customer pays on the principal, depending on what happened. And it's about case by case. When you put your case forward, you engage your RM and you visit your branch, that can be negotiated. It's not a blanket approval, it's a case by case. But many cases I've seen, especially in the last 2 years after COVID, where the bank has decided to forego interest. They say, okay, let's recover our principal and maybe recover only the, we forego the interest and recover the principal. So, but the concern you've put forward, I think it's for discussion, and I want to welcome even other members of this call. It's something to learn about so that we, in the contracts, in the agreements that we sign with banks, even other conditions can be put clearly. And that's actually required by our regulator so that we really disclose everything to a customer. That is part of our regulation. Thank you. Over to you, Ronald.
Oh, there was a question also from I think it was from Monica. Why don't borrowers with good credit history get lower interest rates? The unilateral rates discourage good borrowers. You could possibly comment on that too.
It's actually possible. Many banks have scoring. And if you've looked at the interest rates of the bank, they do climb plus or minus. And some of the things they consider is a good repayment history. Here we do consider it, and if you paid well, it's something that is put in our score. You can be able to bargain for a lower interest rate, which is considered. And that takes me back to the nature of the lender. So we do consider it, and many banks do it. They consider banking, they consider paying. At equity, it is part of our scoring. That can be considered, and actually you have a case to bargain on that. Thank you.
Great. Thank you so much. We'll take another round of questions. If you have a question, please put up your hand and I'll give you an opportunity to ask. But we have a question here from Mr. Saul Abok. He asks, I want a car. Almost everyone advises me against picking up a loan to buy it. What do you say about it? So you could possibly advise him. Someone who wants a car, how should they go about thinking about borrowing for this car? Jacinta says, may ask Ugandans learn to insure. Great, thank you, Jacinta. Rosalind asks, could you please highlight on the interest for different loan products? Possibly a bit further to answer the question of how do we arrive at that interest? What drives that interest? Sometimes people say the bank is at this rate, it's high, but what drives the cost of interest? And then what different interests could be considered? I'll ask Jocelyn, then I'll give Rashid a question, rather an opportunity to ask. I am looking for books on financial literacy that have practical ways for financial management. Any recommendation from the gurus here? Thank you, Jocelyn, for that question. We'll possibly get some recommendations from Fred. We'll also be glad to share. Rashid, please go ahead.
Thank you very much, Ronald. I hope you can hear me.
Yes, I can.
Yeah. So my question, all it's more of an observation, is why very many customers default is you go to the bank interested in a certain loan facility. For example, I'll give you an example, the agriculture credit facility. And we've also, most of us have heard from the news or seen in the newspapers, the low uptake of the agriculture credit facility. In most financial institutions, when you go there, from paperwork, it says that this bank has agricultural credit facility, loan facility. But when you go to the bank, they will toss you around, because they want you to take a loan where there is more interest, where they get more profit. So you end up getting a loan which you didn't go for, but because that is what the bank wants to offer you. I've noticed this. I've actually tried accessing the agricultural credit facility twice. But when you go to the bank, they tell you now that one. They give you conditions that will make it hard for you to what? Loan requirements that will make it hard for you to access it. So you end up going for what they have to offer at a higher interest rate. And I don't know if anyone else in the group has had a similar experience. Thank you.
Great. Thank you so much. I'm going to ask Fred to comment on those questions, and then we could have another round.
Thank you, Ronald. I'll start with the one who wants to buy a car. It depends on, first of all, your cash flows. You need to ascertain your cash flows. Of course, you need to know how much you're supposed to pay in terms of on a monthly basis. Are you earning that money? How is your income coming in? Is it a long term? Is it guaranteed? Or is a salary coming in on a monthly basis? What is the purpose of the car? Is it for just driving around? Sometimes here, say in Uganda, a car has become a necessity because the way we drop our children. If you don't have a car, sometimes it's hectic, sometimes even more expensive to be able to carry your children to school. Is it for that reason? So it's not that you can't borrow to buy a car. I've seen people borrowing, but what is important is the source of income that is going to pay the loan that you are borrowing, but also the purpose of the car. Is it income generating or it's not income generating? When you look at your cash flows, are you able to pay the loan? So I'll advise you to look into that. First of all, your cash flows, and second, the purpose of the vehicle. Is it an addition? Is it an expense to you? Or it will solve. Sometimes there are kind of people, without a car, you'll spend more. And you need a car to do your business, you need a car to execute your activity. So my advice would be look at your cash flows, will determine whether you can get it or not. Someone was asking about the drivers of interest rate. One of the key points is about your cash flows, your banking. Many people don't want to channel their money through banks. And this is key for banks to determine interest rate, how you've been banking. They look at your statement. When we are looking at your facility, your file, your request, we look at how you've been banking. Are you able to channel all your bankings with a bank? Banking doesn't mean that you keep your money there. You put there and save and keep it here. No, it's about using the bank. Collect your money during the day, bank it. Tomorrow you can withdraw. You can even actually bank it in the morning. If you need the evening, you withdraw it and can invest it. Those are some of the cash flows. And some banks will look at that to see whether your business is moving. And that will determine actual interest rate. And sometimes some banks even give unsecured based on how you have been banking with them. Banking, I repeat, doesn't mean that you are going to keep your money there without removing it, but it's about to channel all your money. What you can, like if you collect business collection, don't keep them in a box in your business. Bank it, it will give you some points. But also, the first point it was about the repayment, which one of you mentioned about. If you're paying well, it is considered, and that is the score. Those are two key major things are considered when determining interest rate. But also the other, some banks consider collateral, but here we don't consider so much to reduce interest rate collateral. But key things is cash flow, banking, and also the repayment history, how you've been paying. One was commenting about the SF. Recently, we had a meeting actually with Bank of Uganda about this SF and Business Recovery Fund. That money is provided by Bank of Uganda for us to lend. And it was noted actually they will put it, and some banks are not doing it, they're not lending it. But I'll give you maybe my contact, I'll share my contact, and if you really need that money, we shall be able to give it to you if you qualify for it. As long as your business is aligned with the requirement of SF, it's in agriculture, there's no way they can fail you. Of course, we've seen it in some institutions, but I recommend you come to Equity. I will take it up personally, and I shall be able to serve you, sir. Over to you, Ronald.
Great. Thank you, Fred. I think we'll have another round of questions. Great. John Akimana asks, does Equity offer letters of credit to someone like, does Equity offer letters of credit to someone who is buying equipment from overseas? Is that a facility which you have? If there is any other question, please don't hesitate to put up your hand and ask. I also had, I wanted, Fred, for you to touch on a bit more on generally what drives the cost of interest. I wanted you to help us fully understand what goes into the interest rate, which finally we see at the bank. It could be 20%, it could be 22%. What exactly is embedded in there? Is this the bank taking the whole 20%? How does it assess that interest rate? Then I wanted you to help us compare the interest rate from a bank, which is possibly 20% per annum, and the interest rate from the quick money, the one where you get from a money lender, which may be 5%, 10%. How do we assess them as entrepreneurs? Fred, I'll hand back to you.
Okay, thank you, Ronald. Okay, I'll go on to your question about what drives interest rates. Of course, one of the key things that drive interest rate is about cost of capital, because many institutions borrow and also lend. That is a financial intermediary. They get money somewhere else, one from share capital investors, they give them money and they on lend, but also they use deposits to on lend. So the cost of capital is key. If the source of capital is expensive, also banks or financial institutions will rate their loans highly. And that's why you see different financial institutions have different interest rates, much as they are regulated, and it's upon them. It's not regulated in Uganda. Interests are not so much regulated like in maybe East Africa, where like in Kenya, where interests are regulated. So a lender will depend on the cost of capital. If he's borrowing at maybe 10%, he cannot lend at 10 or 11. Please confirm that you can hear me.
Yes,
Ronald,
we can
you hear me?
I can hear you, Fred.
Ronald, can you hear me?
I can hear you, Fred. We can hear you.
Okay. And I was talking about the cost of capital. The other thing is about interest rate, but the other thing is about the CBR rate. CBR is the commercial bank rate that I think you've seen it increasing day by day. That is the interest charged by our central bank. And you'll see in most cases, whenever it is increased, you'll see interest rates going up. It's a measure of the central bank to try to manage liquidity or inflation in the country, whereby if the rates go up, it is intentional sometimes for them to regulate inflation. I think you've seen in the recent past where inflation has been increasing month on month. So what the central bank does is to increase the CBR rate, and in turn, also banks will increase their interest rate. The issue or the reason there is to reduce liquidity, because inflation, if money, there's a lot of money in the economy. So as the interest go up, then borrowers will not borrow. And in that way, maybe interest is also, inflation also reduces. So it's also independent of the CBR rate. But going back to the cost of capital, which is the main one, sometimes it's about on the treasury bill rates, because the government also lends, has issues treasury bills to try and also manage the economy. Because if the rates are up, because under treasury bills, you can be able to invest in treasury bills. So if the rate of treasury bills, because treasury bills are safe, you can invest money there, they will pay you money. So if the rate is high, they can put it high, maybe to be at 14. So for the bank, instead of investing in the risky projects, maybe lending it to people, sometimes they end up investing in treasury bills that are safe. Of course, the rate can be high, but the rate of default is 0%. So they prioritize investing in that. So if the bank can be able to lend or to buy treasury bills at a rate maybe 15, which is low risky. So if it is to lend you, of course, they'll have to add the margin to cater for the risk basis, because some businesses are risky, and also lending to the borrower, they may pay, they may not pay. So that determines the interest rate different financial institutions really charge about the cost of capital, the CBR rate, the treasury bill rates. That depends on different financial institutions where they get their capital to lend. If it is expensive, of course, they also lend it expensively. And that's why they encourage you to bank with them. Sometimes if there's cheaper deposits, they will lend it cheaply. If there is no money, they have to, because right now, I think you knew towards the end of last year there, when the TB rate were high, people were fixing fixed deposit at 15%. If you are lending the bank at 15%, how do you expect a bank to lend it out at 15? And that's the margin. They add maybe there 5% to cater for other expenses, to be able to cater for their expenses. And that's how rates are captured. Thank you, Ronald.
All right. Thank you so much, Fred, for that insight. Yes, I see Godfrey saying it depends on the CBR prime rate. Yes, I think we have had that adds to the message which Fred was giving us. Jocelyn, please go ahead and ask your question.
Okay, good morning. Thank you very much for the presentation. My question is about the fixed deposit account. So currently we have so many investments happening in the money market, the insurance policies, you have the banks as well. And my question is in relation to fixed accounts in relation to the insurance policies. Do fixed accounts really still sell now? Do they exist? Like, what's the margin, for example, for equity? What would be the advantages of a fixed deposit account over maybe a policy in insurance?
Great. Thank you, Jocelyn. I'll ask, Brian says, will we share slides and the recording? Yes, we will be able to send you these. All of you who registered, we have your emails, so we'll be able to send it to your email after we have managed to download the recording, so that you can share with those who didn't manage to join us. Great. I think there was that question, Jocelyn. I don't know if there is any other question which is coming through on this. If there is any other question, please put up your hand. I think one other question which I had, Fred, was in case I have a loan which has gone bad in one financial institution and I want to solve it, how should I think about that process of dealing with the loan? We have heard about people who say you want someone to be able to consolidate your debt and bring it together. You talked about mismatches. I got a long-term loan for a short-term project. Yes, I got a short-term project, which was supposed to be a working capital loan, but I used it to build. You talked about your workmate. How do I get out of such a pit? What practical measures are available to me if I want to get out of such a pit? Fred, over to you.
Can you hear me?
Yes, yes, I can.
Okay. Thank you so much. Let me start with there's a lady who was asking about the FDs, fixed deposits, and what advantage to them to be done in the bank. Of course, we are still offering them as a bank, an example of equity. The rates range between 12 to 15%, depending on the period that you are fixing UFD. And maybe the advantage with the bank with FD is that we can always give you money. We can always against your FDs. Unlike other investments somewhere else, once you put your money, you have to wait until the end of the period. They can't give you money. But sometimes you have your money there and you have a challenge. What do you do? So if you have an FD, you can always come to the bank and always give you money against your FD. You may not need to terminate it for you to solve the problem. It can be a short-term need, but you have money. So quickly, that's why people utilize fixed deposits. Of course, you are earning interest there, but also we can give you a short-term loan and maybe put a margin of 2 or 3%, but you close it immediately, then you restore because you already have money. Sometimes other investments, once you fix it, you can't terminate it. You terminate it, then all the interest is lost, and as if you've not done anything. Going back to your question, of course, there is a possibility of consolidating your borrowings, especially now when you're stuck with your facility. You've got a facility, you are not paying. Of course, many banks will not buy off non-performing facilities. They may not be able to buy them off. But if they understand the event, of course, there are many reasons why loans go bad. But if you bring it to the face of a lender and you don't explain it, sometimes they may not support you. But if you can justify, many things happen. An example right now, no one doesn't know that between 2020 and maybe 2021, there was COVID. And many banks look at the credit reference bill, the CRB. So no bank, maybe they are there, maybe some financial institution, but I think it. Of course, we can't question you why you defaulted during that period. We know what really happened. And if you're in such a situation and you can justify a reason why you are in default, why your loan is not performing, some banks can understand you. And one thing that you can do is get maybe a longer period. You can restructure it, request for, because an example, you can have like 3 loans in different banks, and many people do this. They borrow here, borrow there, borrow there. You pay different installments and different times. Your cash flow cannot handle that. So it is important that you consolidate your borrowings. In such a case, you can get a bank and be able to consolidate it at once. You pay a manageable installment, because if you have 5 million there, 10 million, 15, why can't they consolidate and give you 20 million? Then they give you a longer period. Then you have a manageable installment. And you say, maybe now I can pay 2 million monthly for maybe 2 years. You can first get a longer period. And maybe when you get money, you can always prepay. You pay reducing principal. So I would advise you to do that. First of all, make sure you disclose to your banks and any financial institution. When you come to equity, we can ask you and understand, was it your cause? Was it a catastrophe? What happened? Maybe it was about what the colleague talked about, the mismatch. The friend I've been talking about, the one who was handling a hospital, I noted that because the loans were not performing well. I had a loan here, I had a loan somewhere else, they were defaulting. But when I visited, I really understood that so it was about mismatch. And my advice to him was to get 3 kinds of loans. One, we structured a development loan so that he can be able to complete his structure. But also we are discounting his invoices. Whenever they are coming in, insurance every month, we give him some money because many customers are on insurance. We discount the invoices. But also we structured for him a facility for working capital. Whenever he needs to pay the doctors and the staff, he comes, he takes an OD, we give him. It was a limit for him to manage. And sometimes you need a bank or a relationship manager that can understand that, then structure a facility. In many cases, loans go bad because there's wrong structuring. And until when you get that right person, that right bank, to be able to guide you on that, on how to structure the loans. Thank you, Ronald.
Great. Thank you. Thank you so much, Fred. I think we just have time for a couple of more questions. We usually want to end at 10:30. Ronald Mwisaka. Ronald, glad to see you, sir. What happens if you have a long time loan, but at one point you have to relocate to a foreign country? So Ronald is asking, if I have a loan here in Uganda, I get work in Dubai, and the loan is long-term, what happens to such a loan? Then Chigwe Godfrey Sebo, thank you for being here. Could you kindly clarify on the difference between loans and overdrafts? Those are 2 quick questions that have been shared. Yes, you could just quickly answer those 2.
Okay, thank you. Loans and
Possibly,
overdrafts.
Jocelyn had another question here. We could touch on it. The question is, Jocelyn, do you want to ask that question again? I don't know whether Jocelyn is still on the call. Jocelyn, can I ask that you unmute and you just ask that question again? Not seem to have gotten what you said in the chat box.
Yes, I asked a question earlier about books, some books on financial management. So,
oh,
the
yes,
number
yes,
of
yes,
books
yes.
you read, yes.
Any books
but
on financial
that
management? I think we'll put a couple of comments in the chat box. Fred, you could also touch on that.
Okay, thank you. Loans and overdrafts. Of course, there are term loans. Term loans, you pay a monthly installments or quarterly, depending on your cash flows. Of course, like I said, in loan structuring, if you get a good bank, a good RM, they always structure your loans depending on your cash flows. If your incomes are monthly, they structure monthly installments. If they are quarterly, maybe agriculture, they structure quarterly payments. Sometimes cash flows are annual, so you just need to pay one installment per month. Sometimes they are quarterly or termly. A school cannot pay monthly. Some of them cannot be able to pay money during the holidays. So that is covered under loan structuring. But those are term loans that are structured and you pay on a monthly basis, depending on your cash flows. When it comes to an overdraft, it's dependent on the cash flows, how your account is moving. And that's what we depend on to give an overdraft. People who deal in a lot of money, they have a lot of cash flows. So for it is not disbursed, not given, they don't give you money. It's a limit that they mark on your account that you can be able to draw money even when you don't have any money. An example, if you give an overdraft of 100 million, we don't give any money to you. It is on your account. Whenever you go to access, you'll access it. Sometimes it depends on your purpose. And most especially working capital, you may not get a term loan to pay installments. Some businesses, you just need money in few, maybe 3 days or 5 days or a month, you bring it back. So there you require an overdraft. And that's the difference. For it, you only draw what you need to use and interest is charged on what you've drawn. If you bring it back and reduce it, it will be charged on the balance. For a loan, if they give you a term loan, they give you 100 million, it is disbursed, interest will be charged on the 100 million. Whenever it reduces, okay, it will be a reducing balance for reducing balance loans. But that's the difference between OD. For OD, draw what you need, use it, bring it back. They don't disburse a loan, but you simply go a negative, you draw beyond your balance. Thank you. And someone said that I have a loan, I want to go abroad, what happens? Of course, it's about loan payment. It doesn't mean that you have to be in Uganda. If you think the cash flows are going to come from abroad, or you have your businesses here, you want to travel, but you know the business will remain here and you'll be paying the loan, you are not limited. You can go and the issue is about paying the loan. Or you think when you go abroad, you'll be able to send your installment through, because even when you're abroad, you can be able to send your money on your account if you have banks like Equity, and the installments will be paid. The issue is about loan payment, not where you are. If you think you've made the correct move to go abroad to make money there, of course, ensure that the installment is paid on a monthly basis or on a particular period. If you need a restructure, then go to your bankers, explain to them that maybe I need a grace period of 2 months, then I'll start paying. Then structure it on that way. Okay. On the issue of books, I think I'll share online. I've shared my box to access to do that, and also I think some more about the books of what you created. Over to you, Ronald.
Great. Thank you so much. I think there is a quick last one here from our regular guest here, Emmanuel Sanyu, about the access code of *247#. I think this is for easy loan. You could quickly touch on that. You wanted to know, I think his specific question is he has been having a bit of trouble with that access. So please just comment on also what easy loan is. I think it's one of your products.
Thank you, Ronald. Easy loans, those are mobile loans. That depends on your banking. You can be able to get a loan up to 5 million based on your banking. You just need to dial *247#. You go to loans, you can borrow. So the bank is able to allow you to borrow up to 5 million, and you don't need to come to the bank. Once you dial *, depending on how you have been banking with Equity, they give you a limit. No collateral, in the comfort of your sitting room, you borrow, you use it, it comes on your account, and then you pay it. For the last 2 weeks, we've been having challenges, but we have been upgrading our systems. Of course, we've got comments from customers where they have been telling us 5 million is very small. What if my account is good? So one of the things we have been doing is to upgrade the system to allow people to draw up to actually 800 million, as long as you are banking. Of course, there is a score that scores you based on how you have been banking. Then up to 800 million, someone can just go to the phone. You don't know anyone in the bank. You don't have to come to the bank, apply, do what. What you need is to open up an account, bank with us. We shall see your bankings. Automatically, a limit will appear. So during the upgrade, we got some challenges, but I know now they are sorted. You just need to get in touch your nearest branch, and then maybe they can do a few changes. You can be able to access. Your limit is still there, and you can be able to access it as long as you've been banking. But we apologize for the last 2 weeks. It's because we have been upgrading the amount and also putting it on different platforms, even on the apps, so that people can be able to access it. That's it. Thank you.
Great. Thank you so much, Fred. Lovely, lovely, lovely. So I think Fred has explained that. Emma, I see your hand up. I'll give you 30 seconds, then we can wrap up.
Thank you. Thank you. Okay. Well, thank you. Thank you so much, Ronald. Thank you, Fred, for that elaborate talk. I'm sure I came here a little bit late because I was having meetings, but I'm sure I'll get the recording. But quickly to the issue of easy loan, I went to the bank branch on Tuesday before the public holiday, and they said they actually don't know anything about it. The system is still down. So if you're giving me assurance that today it is possible, I can pass there, because it is a very good service that helps some of us and also keeps you in check whenever you have to get another loan. Thank you so much.
All right, super, great. Thank you so much for those comments and feedback. Fred, thank you so much for sharing your heart with us. Please do reach out to Fred. Fred, I'm going to request that you just post your number once again. We have another member here from Equity Bank, Nelson. Please also share your contact in the chat box. People want to reach out on some specific services from the bank. Please don't hesitate, but simply go out there and ask whether you can be able to get those services. We're very honored today to have Fred with us. He has posted his number again. It's 0703-817-087. That's Fred's contact. Do reach out to him. Nelson, I don't know whether you're still on. Please, Nelson has also shared his contact, 0752-600-855. Great. Jocelyn, I've shared a couple of comments of both local and we have a body of local writers now who are writing on this subject. We also have a number of books, some of my favorites, Rich Dad, Poor Dad, Millionaire Next Door. I particularly like that one, Total Money Makeover by Dave Ramsey. Also look at the work of Moses Mukisa, both Wealth Files and Straightforward Financial Growth. Very good work on personal finance. Yes, and also we hosted Livingstone Mukasa last week. Do follow him on Twitter also. He speaks quite a bit on this subject. Great. A big thank you, everyone. Thank you so much for joining. The team from Equity, Asante, thank you for making this happen. A big thank you, Nelson, for organizing us and setting us up. We really, really appreciate it. Please continue on this journey. I think if there is one point which Fred has belabored to make, it is the fact that make sure you are getting the right credit. Make sure you understand the credit you're getting before you get it. And don't get credit out of excitement, but get it out of a clarity of purpose of what you want to do. A big thank you, everyone. We thank you for joining us every Thursday. We'll be back next Thursday at 9 o'clock. We'll be sharing with you the topic on our social media platforms. But a big, big thank you, everyone. We are very, very happy that you have joined. If you need education finance from Equity, yes, Christopher Lutuama is also part of the Equity team. He has also posted his contact. Please do reach out to him. A big thank you, team. We are glad that you're here and all the best in your businesses. Let's keep pushing. As usual, at Enterprise Uganda, we say you are at the front line. You are at the front line of kind of transforming this economy. You are the people who create jobs. You are the people who give us business as suppliers, as partners in your business. We want to thank you for that work you do. We know that the job of running a business is a tough one. We know that it's a hard one, but we also know that you are up to that job. So a big thank you to all the entrepreneurs who are on the call and all our regular guests who come to this call. We totally appreciate you and we value you as Enterprise Uganda. Please do follow our social media platforms. Derek, our back office lead, I will request that you post those details. I don't know whether George or Derek are on call. Please just post our socials. But a big thank you. I also want to thank our back office team, Derek and George, for keeping us connected during this period. And thank you, everyone. Have a blessed day and have a lovely rest of the week.